How is everyone today? Good? I want to start this off and actually ask who in here trades, like actively trades the crypto market? So actually not too many. Okay. Do you keep your hands raised for people that like use technical analysis? Okay, so there's a few. Cool. Perfect. So basically I'm going to go over a little bit of TA, but a lot of it's going to be like market cycles and psychology that most people aren't really thinking of. It's kind of like, you know, you can look at TA as like, it's very technical, obviously. It's very like to the point, but there's a lot of psychology and shit in the background that you need to know and be aware of as well. So we'll start it off. So it's a real look into where, when, and why we use charts and technical analysis. And don't be fooled by the hype. Our panel kind of explains some of the stuff that I'm going to be talking about, but the hype is a big one. And I say that because I'm sure everyone's aware of last year, what happened with cryptocurrency, especially Bitcoin. That parabolic move that we all saw, that's not normal, and I'm sure everyone's aware of that. That was hype. That was the news coming in. You know, your friends and families talking about, I made 50%, you know, over the weekend, and the person is like a car salesman or something. You know what I mean? Like, it's not normal. So everyone wants to be, kind of like Chase said, everyone wants to be part of that and make easy money. So the biggest thing is you can't be fooled by the hype. On a psychology level, there's always like a motive on the other side. So when you are seeing headlines in the news, CNBC, whatever it is, there's always a motive. If somebody's saying, you know, like markets are bullish, for example, like, oh, everyone's extremely bullish right now, that's when you should be looking at why are they saying that. You should be taking the opposite side, because whatever's controlling the masses or whatever's pushing the masses, you need to be taking the opposite side, because big money is taking the opposite side. So money is and will be made by the educated. Cryptocurrency has started to finally creep its way into the mainstream of last year in 2017. Again, that's more hype driven than anything. Myself, even personally, and I'm sure there's a lot of people in here, you know, sad to say, the tech behind crypto right now, I don't give a shit about. It's not that I won't in the future, but like, it's a vehicle for me and that's it. In the future, it might change, but right now it's not. And I think as what I'm trying to say is it's not going to be, for most people that got in last year, it wasn't a tech thing. Nobody knew what it was. If you ask somebody, what is Bitcoin, what is blockchain, nobody knows. Everyone just kind of got in because it was easy money. They saw charts going up. They saw their friends and family making easy money, and they just rolled with it. But it's still in its infancy as well. So there's a study by Finder.com shows that that only 8% of Americans have purchased cryptocurrency. Here's a little graph by Cointelegraph. 8% own crypto, another just under 8% don't own crypto, but they plan to own it, and about 85% have no plan to own crypto. I do believe that will change. The survey found 92% of Americans have not bought any cryptocurrencies, but 8% of those, as in the previous slide, planned on buying it in the future. Average amount by Bitcoin held by each of those 8% is about $3,500. And also too, my slides were on my computer, so if there's any mess ups on the slides, just letting you know, it's just because we had to change computers as well. According to the survey, the majority of both men and women think that there's no need or they're disinterested. For those people that are not interested, these are the reasons. It's too complicated to understand, it's too difficult to use, it's a scam, there's too many fees, there's no need or they are disinterested, it's a bubble, and it's too high risk. It's more important to keep these stats in mind because they'll be relevant later. So let's take a quick look at the psychology and market cycles. This is again what we kind of briefly spoke about on the last panel, but every market has cycles. And actually it's really funny, just to go quickly because I know I don't have too much time. Candlestick charts, who's aware of candlestick charts? Awesome, hell yeah. Okay, so most people are aware. That actually started from a Japanese rice trader. Like long time ago, long time, hundreds of years ago. And he would go to the exchange where they would trade rice contracts, and he would manually draw down the opening price, the closing price, the high and the low, and he did that every single day. And that's how he ended up figuring out charts, and that at the end of the day, it wasn't even supply and demand per se, it was greed and fear. That's all it was. It was human emotions. It was irrational. But then he saw over time that it was just cycles. Over 10, 20 years, it would just go up and down, up and down. But it was fueled by a couple of things that we're going to talk about. Has anybody ever seen this chart before? Or this picture? A couple people? So this is the psychology of market cycles. Again, we kind of start, kind of in the disbelief. Nobody knows like kind of what's going on. Then you have the hope, right? On the front side, it's like, okay, it might be something. On the back side, it's more of like You have optimism, so the rally is real. Belief, time to get invested. You have the thrill, I'll buy more on margin to get everyone to buy. Kind of like December, if that reminds anybody of that. Euphoria, that's going into like the holidays where everyone is just talking about it. Friends and family, you need to get in. I just made 100% last week. Like all that shit, it's not real. That's when you should be scared. And actually I have a really quick story about that. I have a friend who got into crypto, I want to say like September of last year. He put like 100K into crypto, didn't know what he was doing. He just threw money in. And he kept updating me because his portfolio was going crazy. He's like, I'm at $250,000, I'm at $500,000. I vividly remember this going into like January. And he said, he hit me up and he's like, I'm at like $1 million. And I told him, I was like, you need to be selling. Like you're being way too greedy. You don't even, literally, like you don't even know what you're doing. You just put money in. You just happen to be at the right place at the right time. Like, what are you doing? That's $1 million you did not have. You should be selling that. He's like, but what if it keeps going, right? That's like what everybody said, keeps going. That was euphoria, right? He's greedy. He doesn't know why he should sell. He thinks it's going to continue to go up. And it's funny because on top of that story, I was at Starbucks when this happened. This was, I want to say it was like just at the end of December. And I was in Starbucks and I overheard a conversation. I was eavesdropping on a conversation about two people talking about Bitcoin, but they didn't know anything about it. They were just like, so I heard about this Bitcoin thing and I don't know anything about it, but like I put some money into it. And like, to me, I was just like, I was like, dump it, like that's bad. You know what I mean? Like when you just hear random people in a coffee shop talking about it, they don't know what the hell it is, but it was easy to get into it and they threw money into it for no reason other than everyone's talking about it. That's euphoria, right? And then you have the complacency. This is where the distribution takes place. This is where, early adopters, early investors are trying to liquidate their positions, but they won't dump it all at once because depending on liquidity, they could have potentially, dump a whole market. Nobody wants to do that. They don't want that to happen. Then you go down the line, you go to anxiety, denial, panic, anger, depression. I would argue we're maybe like in the anger phase right now in Bitcoin. Maybe getting into like depression. So we'll go to the next one. So there's 4 cycles. So you have your accumulation. That's like early adopters, right? So that's the early adopters, early investors, people that were aware early on. Big money. When I say big money, I just mean, like whales per se. People with a lot of money that know what they're doing. So you have accumulation. Then you have greed. This is when prices are rising. Everybody wants to be involved. Easy gains are being made. And then you have distribution. That's kind of where it takes a little spill, but then it evens out and people are like, it's going to be okay. We're probably going to be okay. But it's actually big money from early on, slowly liquidating their positions. Okay, that's not like fresh money, like, coming in to like make, it's fresh money to sell to the big money positions. So that's distribution. And then you have fear on the backside. And that's again when the big fades happen. That's when the pain starts hitting. People get worried, scared, etc. And then it repeats over and over and over. So despite popular belief around why assets are priced the way they are, in markets it's important to understand this. Markets are mainly driven by human emotions, kind of like I explained with the rice trader. On top of that as well, they said the rice trader, if he was alive today with how much money he made at the time, he'd be the only billionaire trader, making $1 billion as a trader. Fundamentals play a role in the markets, but these following 2 human emotions actually drive market movements. Who can take a guess? Boom. Fear is number 1. And I put in fear first because I actually probably could have asked that question. Does anybody understand why fear is actually more powerful than greed? And some people might actually argue that. Yeah, go ahead.
People are more scared of losing than they are gaining.
Yep, that's one of the right answers. Go ahead.
Fear causes you to react.
That could be true, yeah. The other answer is fear is also being afraid of not having enough resources. So it's actually still more powerful than greed. But both of those are really right. When things go bad and there's blood in the streets, nobody wants to be the last one to the exit door. And we'll talk about this in a second. Yeah, these slides are a little bit messed up. I apologize for that. This is typically why sell-offs are much more violent than the rises upward. So if you look at charts and you see sell-offs, they're really violent. You know, when people come in and there's a lot of volume coming into the downside, it's much more violent than the ride up. The ride up is usually typically pretty smooth, smooth sailing, and then you have big sell-offs because nobody wants to be the last one to the exit door. So for example, I actually, this is on Bitcoin early September. So in our crypto watch on our Facebook group, I posted this chart where we had a huge bearish divergence. And we're not going to get in, again, there's just not enough time to get into all of it, but what we had here is we had new highs coming into the market, but you can see our RSI and our relative strength index and our MACD, they're actually losing strength, meaning our prices are rising, but the strength is actually weakening. So like the way, the analogy I like to use it, like pretend at the beginning of that rise, you know, everything's really, really strong. It's like a bodybuilder. He's working out his whole body, legs, upper body, everything. And then as time goes, he's getting bigger up top, but he's just basically neglected his legs. So it doesn't take much to basically like kick his legs out, and then the whole house crumbles. So for example, 2-week climb, that took 2 weeks to happen, but it only took 1.5 days to wipe out all those gains. So again, that's kind of where the violent sell-offs are much more powerful than the slow rises up. So the second one is greed. Greed has many faces, but primarily seen in FOMO and irrational exuberance. And irrational exuberance, for anybody that doesn't know, it's just very like fairy tale. Like it's going to keep going. We're going to keep making money. It's just not real. It's not rational. Both just as bad, driving up prices for no reason other than greed instead of the fundamentals. Fundamentals in an asset carry weight and an importance, but you have to remember markets are also based on supply and demand. If there's more demand, prices rise. On the other side, when demand falls, prices fall as well. The back and forth of greed and fear has major influence in markets on a constant basis. Fear and greed is what gives us market volatility, which is great if it's taken advantage by traders and investors alike. The problem is most people have no idea what they're doing when it comes to diving in the cryptocurrency markets. And without an understanding or any education, this usually ends in frustration. Sorry, these transitions aren't as good as they were supposed to be. Most people get their information from their friends and family and the media. Unfortunately, we are still so early for most to understand the opportunities at hand, resulting in a lot of misdirection. We talked about misdirection earlier. Again, kind of essentially taking advice from somebody that just has no place in that. If they're not studying cryptocurrency or markets and they just come out of nowhere and say, oh, you need to buy this, like that's misdirection. It's not real. You're just kind of trusting blindly. It's just blind. It's blind direction. It's misdirection, which leads to uneducated decision-making, including manipulation and hope. I mentioned misdirection in the media because most people that get involved or are involved already likely purchased into positions based on others telling them that they should do so without doing their own research, because nobody wants to do their own research because most people are lazy and they don't want to do the work. You need to do the work. You can't just rely on people telling you what to do. You would never put your money, even though it happens, you would never give your money to somebody without them kind of knowing what they're doing. So you need to be doing your own research. When friends and family started talking about cryptocurrency in the fall of 2017, everyone was interested. Nobody knew exactly why it was so great, but that everyone was making money because prices kept rising. This is what creates FOMO. And if anybody doesn't know what FOMO means, it means the fear of missing out. It's also known as the quickest way to end up losing money, and I'll explain. So here's another way to look at market cycles compared to the previous slide that I had. You can see it's very similar. You have optimism, excitement, thrill, euphoria, anxiety, denial, fear, all the way down to panic, depression, and then it recycles. Up top, you can see the little box, that's euphoria. That's when most people are interested because everyone's talking about it. It's fun now because everyone's making money. And when it's fun and everyone's making money, the more people talk, it spreads like wildfire essentially. Because who doesn't like making money? If your friend comes to you and says, hey, I made 100% this week on a position, I want to be involved. Like, who wouldn't want to be involved? You know what I mean? You want to know what they're doing. This is actually the area of maximal financial risk, when everybody's talking about it, when it's fun, when it's cool. When I hear something that, whether it be any kind of market movements, when I hear everybody talking about it, again, I play devil's advocate a lot in the market. I like to look at the opposite side, because I look at where the most money, where the max pain is, and where big money can take advantage of all the people talking about it, and it's usually to the opposite side. So the FOMO usually occurs when the risk is actually the highest for the trader and investor. This is when everyone is talking about easy money being made. It's your Uber driver, your barista, mother, dad, brother, sister, etc. During this time, it's purely emotional, and it only gets worse from there. After the thrill, euphoria, and greed, the natural distribution process of funds starts from the early adopters, investors, and traders into the fresh hands who jumped in because their friend of a friend told them, we are all about to be rich. I just made 50% last month. Don't miss out. This is where those stats from earlier come back into play. The rest of those people who are not in, who are still not involved, get intrigued and put fresh money into the market. So the early adopters, they have to sell to somebody, right? They're not going to sell to each other. They have to sell to fresh money. The problem with this is it's purely emotional. There's no reason besides greed, and this creates a domino effect on the backside when the pain starts hitting. You can see the stages of the market on the backside turn from euphoria to anxiety, denial, fear, desperation, and panic. Oddly enough, when there's blood in the streets, this is actually your best time to be feasting. And I say that because when everyone is worried and you know, scared and like, you know, complaining and just feeling like desperate and you know, depression type of stuff, when the pain is far too much to handle, you will see the accumulation once again by smart investors, traders alike. So again, if I feel like it's a pretty smart room, like you kind of know this already. When everyone's scared and when it's really, really bloody, that's also the time to be looking for your discounts and your best entries. On the backside of that, you don't want to be catching a falling knife. So if things are just taking a tumble, unless you know what you're doing, you shouldn't just be jumping in blindly thinking, okay, it's taking a tumble, let me just get in because they're cheaper. That's where TA comes into play as well. This is where your actual best risk versus reward happens, and it may seem backwards, but it's not. Again, it seems backwards. If everything's red, everything's bloody, and everyone's losing, you think, why in the hell would I put my money in when everyone's losing? Like, that's actually your best time to be getting into a long position if you're going long. This is when buy the weakness and sell strength is executed. When everyone is afraid and fearful is when you should be most active to find your entries and your discounts. So there's also a saying, you buy into weakness and you sell into strength. So if the market is taking a move to the upside and it's strong, you should already have a position from lower, and that's when you should be looking to sell. You should be selling into strength, you should be buying weakness. Again, these are all if you're going long. It's not like a shorting side of things. So you need to control your emotions on the ride back up and make sure you don't become greedy, or you'll fall into the cycle of emotional, psychological, and financial pain. I would argue that FOMO is the biggest reason why most people lose money in the markets. Can anyone take a guess on what FOMO truly is at its core? Anybody? Say that again? Well, that's what it means, but does anybody know what it really truly is? FOMO, at its core, if you feel FOMO, what is that? I still haven't heard it. Go ahead. Envy? Not envy. Everyone's really close. Nope, not greed. Nope. Left out? Nope. Just jealous. It's emotional. It's an emotional feeling. FOMO is emotional. All of those answers are technically kind of right, but it's emotional. It's emotional. It's an emotion that you're feeling. Envy, greed, you don't want to miss out. Everyone's making easy money. It's emotional. It's hope. And guess what? There's zero room for emotions and hope in the markets. None. Never forget that the markets do not give a shit about you or your money. That's probably like the best thing I could ever say about the markets. If you haven't taken a screenshot of anything, that's what you need to be thinking about. Because it's really easy to think that, oh, you know, the market might care about my position, or like you're hoping, I think I'm gonna make money on this. It doesn't care. You're dealing with like the most savvy people in the world, sometimes, not all the time. It doesn't care. It'll make you, trust me, if you've ever taken big losses before, if you're doing really well, you'll get really cocky, you'll get really greedy, but the markets have a really quick way of humbling almost everybody at one time or another. The quicker you remove emotions in the market, the quicker you'll be able to see the profits and progress. This is another thing I want everyone to see too. I can't remember the source of this, so I'm obviously not taking credit of this, but I keep this on my desktop, on my computer. I read it like probably 3 times a week, and I'm gonna read it out loud if you can't see it. Welcome to the hardest game in the world. Unfortunately, you're playing with some of the sharpest, fastest, most intelligent, well-informed, stubbornly irrational, and in many cases, unethical minds in the world. You're up against the computer that can react faster than you, the trader who has more experience than you, the fund that has more money than you, the insider that has more information than you. The others will misinform you, and your inner voice that will do its best to undo you. So leave all your dreams of making quick and easy money behind. The first aim is survival. I can't stress that more than anything. Survival is like #1. If you can survive in the markets and not lose, you're already way ahead of the game, just to survive. Break even, you're already doing better than most 99% of the people. Your absolute first goal is to learn how to stay in the game. You can only do this by mapping the territory, by understanding how the enemy thinks and acts, and by having a solid game plan, and by picking your battles very, very carefully. Are you ready to play? Has anybody ever seen that before? One? Only one person? Okay. There are 2 ways to keep emotions at bay in the markets. One is your position sizing. We talked about this earlier in the panel. If you are, the cool thing about like the body, the human body, is like, you know when you feel nervous or you feel like, it could be like a flashback or something, you get goosebumps, right? Like you can't control that, right? Like that's your body telling you something naturally. The market will easily tell you if you're in a position you shouldn't be in with too much size. Because when you see the price rising, whether you're up 5% or you're down 5%, if your heart starts pumping, and I'm sure that, has anybody been in a position where it's going one way or the other and your heart starts pumping? You can literally feel your heart rate change. Few people. You have too much money on the line. You should literally be like a robot. You shouldn't be changing anything. You should be able, as crazy as it sounds, when you take a winning trade, it should almost be like nonchalant, like I expected that to happen, that was supposed to happen. So your position sizing is #1. That's probably the #1 mistake that most people make, and that basically gets you emotional really, really quickly is your position sizing. So when people say, how do you remove emotions? The #1 thing I say is, what's your position size? You're in too big. Slow your roll, like take smaller positions. You don't need to go all in. The second is to have a plan. That's another one. Sorry, the slides, obviously I told you the slides are a little messed up. Having a plan, that's the other one too. Nobody has a plan for the most part. Everyone just kind of jumps in. They're like, oh, if I get to 3%, 5%, whatever, I'll take my gains. But there's no real plan. There's no real entry. People just kind of jump in without a plan. You have to have a plan. You almost literally have to act like a robot. Your entry and exit should be almost automatic, no emotions involved. You need to have the plan from the beginning. So we briefly covered that the problems most have when they get into crypto is FOMO, they're uneducated, and they have no plan. This is where the education part comes in. To have any chance to survive and profit in these markets, you need to build a foundation. And if you're not investing long-term, thinking like 1+ years, you're trading, even if it's a month. If you take a trade right now and you enter and you sell it next month, you're still a trader. You're not really an investor, you're still a trader. But on what foundation? So this is where technical analysis comes in. What is technical analysis? So technical analysis is an analysis methodology for forecasting the direction of prices through the study of past market data, primarily price and volume. Another thing I like to say that I'm most excited about, and we get asked this a lot, what I'm most excited about in cryptocurrency Again, yeah, the tech will be cool someday. That's just not me personally. I'm just excited for maturing charts. You know, the more data we have from the past going into the future, the more reliable everything becomes. So trades get, you know, your conviction on trades might be a little bit stronger. You have more data to work with. And that was a big issue last year, is that people were jumping in to positions, like the charts, you know, they might do like 500% like in a day. And they're like, you didn't get any of that? I missed all of it. All of those easy gains last year, I missed it because I have too much discipline that there's no reason for me to be in them. The charts were like 3 days old. You know, what, as a TA guy, like, what am I gonna do with a chart that is 3 days old? There's like 3 candles, you know what I mean? Like, there's nothing there for me to work with. As time goes on, TA becomes more reliable because we have more history and more data. So using the past data to predict the future, since fear and greed are driving forces, markets tend to reveal patterns over time based in cycles. This is what technical analysis indicators look like when you have them enabled on a chart. Now, I know this might be intimidating to some, it might be normal to some, that's okay too. This is just a chart with a few indicators. We have moving averages, volume profiles, RSI, the MACD, the stochastic RSI, and then we have a version of a squeeze with Bollinger Bands and Keltner channels. So there are so many indicators, and that's another thing too. There's so many TA indicators that you can use, and it can be confusing on where to begin, and I want to say this too. A lot of people think like the more indicators, the better. Like if I have 20 indicators on my screen, it's gonna make me better than just maybe like 4 or 5. It's not true. More indicators doesn't mean better in any way, because sometimes they can contradict each other. You know, one might not be as reliable as the other, but you don't need. If somebody says you need 10, 20 indicators on a chart, you really don't. You can keep it pretty simple. Some of the best traders in the world, they only use a few indicators because they just know them so well. They know the assets so well, so they know how everything reacts with each other. But I'll give you a few that we use that are reliable. So if you're not sure, you can write a couple of these down. These are easy to get started with. That's the moving averages. Very, very simple. You have the simple and the exponential moving averages. We'll go over those in a few minutes. The volume profile. We have the RSI, which is the relative strength index. We have the MACD, the moving average convergence divergence, the stochastic RSI, and then we have Bollinger Bands and Keltner channels, which are my favorite personally. Unfortunately, we don't have enough time to break down all of the technical analysis in detail of each indicator. So again, if you were writing those down, you can look into them. Those are the ones I would recommend personally. Those are the only ones I use and that we use personally. There's one set of indicators I really want to briefly talk about really quick. And that is, and there's a reason for it as well. So the moving averages, again, these are, if you know TA and you know charting and you know trading, moving averages are pretty basic. They're like probably one of the most basic indicators you can put on a chart. But there's a good reason for them, and there's a reason why they work so well. So they're popular and reliable indicator in TA. They smooth out price action in easy to follow lines over time. There are 2 different types. You have the simple moving average, which is also referred to the SMA or the MA. And then you have the exponential moving average, which is usually referred as the EMA. The SMA is best used for longer time periods, for example, swing trading, which can be anywhere from a couple days to a couple months or even years. So the simple moving average is going to be best for not like a day trading situation. Exponential reacts faster. We'll get into that in a second. Well, why the EMAs are better used in day trading situations because they're closely tied to the price, which makes them a little less smooth and tied more to the price because they're all lagging indicators, but it's a little bit less lagging. It's much faster to react to the price action. For example, so let me come down here and make sure I have it. Okay, so the orange line we have here, we're going to get feedback. The orange line here is the simple moving average. And you can see how it's much slower to react to the actual price. Easier to see up on this curve or this fade right here. So the moving average was much slower to take its curve back down to the downside, while as the EMA was much faster to react to the price. Again, day trading, maybe even swing trading, EMA is a good one to use, but simple moving average is still probably the most the most basic, but also one of the most reliable indicators. And I have a couple examples I'm going to show you as well. MAs are the most used TA indicator by global money managers. Oops. They're used to manage more funds than any other TA indicators combined. So again, moving averages are very simple. You might say like, oh, moving average is like, that's so basic, you know, it's basic shit. Like, yeah, but they're also used to manage, you know, as far as like entries and exits by the most money in the world compared to all the other TA indicators combined. So they have a lot of weight to them, so don't disregard them. It's safe to say, while seemingly simple, MAs still hold the most power in the markets regarding TA as an indicator. For example, on December 22nd, 2017, when Bitcoin took a big hit, everyone was panicking. We have our Crypto Watch group, and I was actively posting when this was happening. I was able to scalp about 30% profits in a total of 3 trades using just the MAs, and that was like in less than 2 days total. And hopefully this will work. Okay, so for example, these are just simple moving averages, so you can see the huge fade. I essentially was just buying the moving average bottoms and then selling them back on the tops. These trades, these 3 trades I made were simple, just MAs. It was no other indicator. I didn't care at the time. That's all I was basically buying the bottom, selling the top when it came back up and hit the next moving average. So I made a post on December 22nd when this was happening. For all, because another thing too, because crypto is still so early, there's a lot of people that said TA doesn't work in crypto. And I had to keep telling people, yes it does, yes it does. And you know, you had your doubters that, I think Randall, he remembers there's a lot of people that were saying TA doesn't work. So when this happened, I just, you know, used an example out of them saying, you know, for all the TA doubters, this should help you turn into believers. Compare these buys and sells to the charts. And you'll see a beautiful bottom bounce on these levels, almost perfect. And that last one on the way to the airport this morning was perfect with buffer, not get greedy to catch a perfect bottom. Getting filled is more important. So the reason why I say that too really quick, a lot of people want to find a perfect entry. So if you're looking at a moving average, for example, say, hypothetically, say the moving average is at 100. Say you're looking at Litecoin, right? We're at 105, it's coming down. You have a really strong moving average at 100. Most people will put their buy at $100, thinking like, I need to put it right on the moving average. You need to give yourself a buffer. I always call it giving yourself a buffer. I'm okay with like a little percent, you know, not a perfect fill to get filled. So I would put my buy maybe at like, you know, 150 and then another at 125 cents. You know, I don't need to hit the bottom perfectly. When it happens, cool, it's awesome, right? It feels great. You hit the bottom perfectly or hit the top perfectly. Leave buffer. You don't need to be perfect. Getting filled is way more important. I say that because there's so many opportunities that you'll miss if you try to get that perfect fill. If you try to hit that perfect fill every single time, you might come down right to it and you'll miss it by like maybe 5 cents and then it pops right back up. You don't need to be perfect. You can give yourself just a little bit of leeway. Just consider it the cost of business. You don't need a perfect entry. So if you miss maybe 1/4%, that's okay. Consider that your cost of business. Just get filled. So again, these were the trades, and I have the confirmed trades as well. That was just a screenshot of Coinbase. These are the trades that I made on that time, the buys, the sells, the prices, and it was just about like 30% in under 2 days. Again, I was just doing a live thing. I don't know if the video is going to work here. This is actually a funny video. So I was filming this for the group. I had music behind it saying like, everyone's panicking, but I was like just chilling. Like, this is fine. Like, that was literally me when this was happening. I'm like watching this all happen. I'm like, this is fucking awesome. And everyone's panicking, right? And if you saw too on that video, you can see that moving average. Can everyone see that? At the bottom, that little line that's crossing across. So that was the moving average. So again, that's where I was looking for my fills. During this post, there's a couple of our guys in the watch. You know, just saying, you know, I remember 6 months back, you and I were telling people that TA works in cryptos, and they said it was stupid and the market was different. Glad you can show us this type of stuff, proving people wrong. You know, another one said it's funny because traditional TA works better in crypto than the stock market. People are idiots sometimes. Funny thing about that is that when people talk about manipulation in crypto, I literally laugh every single time I hear manipulation, because crypto, while it may be slightly manipulated, if you've spent any time in the big market, we aren't even being touched. Like, we are not even being touched in any kind of manipulation, in my opinion, at all. Like, if you've watched and you sit down and you have solid screen time in the big market, that is just a one giant manipulated clusterfuck. It seriously is. It's all it is. Like, just take money from the people that don't know and try to fool them some type of way to take money. The crypto isn't even like that yet. There are a couple times where, you might see something that, for example, I know there was a big wedge last December, and I said, don't be surprised. It was closing in like 2 days or 3 days on a daily chart. And I, alerted the group. I was like, don't be surprised if you see some kind of headline come out, like in the next couple days, to move this in one way or another. And it was less than like 24 hours. I think it was like 16 hours later, huge headlines. I forget what the news was exactly, but it was like published everywhere. So again, the cool thing about TA too is once you start learning TA and you understand it, you can kind of predict where news and media will actually push something one way or another. Another example, I had a put position on Sprint, put options. There's a big death cross happening. Meaning we're, lack of better terms, we're likely going to take like a fade for like maybe a few months. It was on a daily chart. It was literally crossing that day. The MAs were crossing to the downside. I took a put position. I was going to hold it for maybe like a month or two. Literally the same day, Warren Buffett might buy Sprint. Like all over the news. Like completely fucked my position. And like that's manipulation. So like again, crypto isn't even being manipulated yet. Like so when you see enough in the market, you can kind of understand what to expect from news to push something in one way or another. So what happened that day is they announced rumors. Obviously the price popped back up. The death cross didn't happen. That lasted for about 3 days, and then these rumors fizzle out like, oh, just kidding. And then what happens? It came right back down. So like again, has anybody seen manipulation like that? Has anybody actually seen some type of manipulation like that? A couple people. If you haven't, you will at some point. And unfortunately, usually you'll see it, you'll be more aware of it in a position you're in because you're paying more attention to it, rather than just some random news about Sprint, thinking like, oh, it's just, it's a rumor, right? But if you were actually looking at the charts, that would have told the story that something is probably going to be said. So TA isn't something you can just pick up overnight. It takes time, dedication, discipline, patience, and I'd even throw passion into that mix. It's funny because people often ask me, like, what books would you recommend to learn TA? And it's a tough question. I mean, it's an easy question, but it's tough because I literally don't have any books. That answer is non-existent. I haven't read a single book on TA at all. Instead, I kind of went right into the trenches, and I'll explain here. So when I was about 13, I watched a movie that touched me, and I'm sure a few people probably know what movie that is. I'm 28 now, so I was 13, it was about 15 years ago. Anybody recognize this guy? Yeah, a couple laughs. So that's Gordon Gekko, Wall Street, Charlie Sheen. This movie is just incredible. Like, after watching this movie, I was like hooked. Like, I knew at some point, I told myself, like, if I'm not where I want to be in life by the time I'm 30, I'm going to go to Wall Street, and I'm just going to be a wolf on Wall Street. I'm just going to kill it, do whatever I got to do to make it happen. So that movie kind of like changed my life when I was younger because it just gave me that passion early on about the markets. I was saying, like, recognize the same look. I learned TA from being passionate, and that's honestly where it came from. I was passionate about the markets from early on, so years ago, I sat my ass in front of the screen, and I watched the markets for a year. And when I say a year, I'm not joking. I literally took a year of my life and watched, I had all the media on TV, mostly for educational and like entertainment, not educational, entertainment purposes, because again, it's like inverse effect. They publish something on the news, I want to see how everyone reacts to it, and it's usually the opposite. They might trick you a little bit at first, but then it usually comes down the other way. But I sat my ass in front of a screen for a year. On California, I don't know if everyone's from here, 6:30 in the morning to 1. I was there every day. I maybe missed like 3 sessions, and I just watched price action in the charts and just figured it out. That's literally how I learned. Probably not the best and the best use of time, but that's how I learned. I call this screen time. So watching the markets, being on the pulse of what's happening. That's a big one, being on the pulse of what's happening, being aware. So if you take like 2 months off of watching the market, it's a little different than if you're watching the markets every day. You're kind of feeling out how the market's feeling. Being on the pulse is really important. then also having media turned on, but mostly, again, I have the media on because I just want to see what they're pumping to everybody. I don't care about what they're saying for the most part. I just want to see, a lot of times I take like the devil's advocate approach. I always just try to see who's screwing who and then where is the most money being made. Because at the end of the day, nobody in this room, I'm assuming, can move markets, like really truly move markets. So we're all kind of just riding the coattails of like true large money. So, and essentially at the end of the year, I had a grasp of what was going on in the markets and happening based on the psychology, the manipulation, deciphering price action, etc. I'm not saying you need to sit in front of a screen for a year, but I learned the hard way and arguably probably the better way with blood, sweat, and yes, a lot of emotional days early on. Again, like too much position, right? You get goosebumps, your heart starts racing. Like I vividly remember those days. That's something you almost have, I feel like you have to, and you're better off if you go through that the hard way. But TA takes time. Thankfully, when you put in the time, work, it can open up a world of opportunities within the markets. The great thing about TA is once you kind of start really getting it, and I look at a chart and identify what's happening, you're literally just looking at a chart trying to identify the opportunities. That's it. And then it becomes you know, essentially when you know it, you're identifying. That's it. You're just looking for the opportunities. None of us can control the market. We're just looking for the opportunity. Unfortunately, we didn't even scratch the surface. There's no way I could even touch on like anything. TA is very in depth. That's the other thing too. There's no way in 40 minutes or whatever it is that we could really even talk about TA in advance. But we do have something that we know will help a lot of people, and it's quick and it's easy to start today. Using TA indicators and specific conditions that need to be met, we can offer our alerts service. So currently we cover about 20 to 25 cryptocurrencies with bullish and bearish signals. I would never tell anybody to buy and sell because that's financial advice, and I am not a financial advisor, so I'm not going to say that. For our members when specific conditions have been met using TA indicators. We give you the heads up via email, Discord, which you can set up with mobile alerts as well on good times to look at your entries and exits. This is not a get-rich quick situation. A lot of people look at alerts saying it's foolproof. It's like, I'll just make money. That is not the case, and please do not look at it like an ATM because it is not at all. If I said that to you, I'd be lying, and I'm not going to say that to you. We are simply alerting you when the coins are turning bullish and bearish in 2 time frames. So we have a swing term, which is about approximately like 3 to 7, maybe 2 to 7 days in and out. And then you have the long term, which is going to be, transition a little weird. Long term is going to be approximately about a 10-day hold plus. It could even be 20 days. It might even be a month. So that's at the watchersalerts.com. I don't know if anybody wants to take a picture of that, just so you have it. It's a pretty easy domain to remember, watchersalerts.com. And we have 3 packages. We have our monthly package, we have our annual, and we have our lifetime. For today only, so our monthly starts at $197 a month. Our annual once a year is $14.97, and then we have our lifetime, which is $29.97. Today we're doing 20% off in the back. I don't know if you can see them. They'll be raising their hands back there. They have forms you can fill out. We can get you set up in the alerts today. And we're doing only 20% off today as well. We don't ever do that, or we don't have any discounts for that. That's only for this. There again is the link. I also have a couple more here at the end. Another thing I wanted to say, again, there's so many things in TA. So you have your indicators, then you have your other situations where I kind of mentioned earlier, like bullish and bearish divergences. For example, is anybody watching the big markets right now, like the S&P, for example? A few people. So everyone's seeing that it's like taking a giant fade right now, right? It's down like 7%, 8% from its high. It might be even a little bit more than that. September 17th in our group, we have a pretty significant bearish divergence on the weekly S&P Futes and the S&P chart. The weekly chart holds a lot of weight because the weekly chart takes a long time to happen. It's not a 5-minute chart where you can take that whole chart in one day. So this takes years and years of data. So what I saw when I was looking at the S&P on the weekly chart, we had a huge bearish divergence similar to the Bitcoin one that I mentioned earlier. When the price is making all-time highs, But the RSI, basically the strength behind that move, is actually diminishing, and by significant amounts. We were crazy overbought per se, and then we're like not even close to being overbought on the second high. That signaled to me that we're likely going to take a fade, that's not going to hold. So I made a post letting everyone know this would not be a bad time to take your profits if you are long on FANGs, for example. October, December monthly puts wouldn't be a terrible idea here. I took October monthly puts, I sold those for about 50%, too early unfortunately because they did go to about 3,000%. But my November puts, as we just mentioned in the last panel, I took that profit on it today. And I'll get into that. Again, this is just an easier chart to understand. So you have price that is rising, right? Price is rising, but the indicator is showing a contradiction to what the price is doing. But the indicator is actually right. So that when you see these divergences, it's meaning the price is contradicting what the indicator is saying. And so the bearish and bullish divergence are really good, good opportunities and good trades to take because they work out pretty reliably. And on a weekly chart, my conviction on this was pretty damn strong. I had the November position. I think I entered that maybe like 2.5 weeks ago, and I finally just sold it today. And like some might say that's greedy, right? Because I was holding and holding and holding, but like my conviction on this was like just so strong that I wanted to squeeze as much as I possibly could out of it. Again, this is just a 15-minute chart today. I literally made this slide in the back when a few other guys were up here earlier, just so you can see like on a shorter time frame how big this fade really was. Again, you can see, let me go back to the last one. This is a weekly chart, right? It took, or no, yeah, this is the 1 week. So the last like 3 weeks basically wiped out all of the gains from April, all the way back to April. So in just a couple weeks, we wiped out all of the gains that it took from April. So again, on these divergences, for example, and not even divergences, but just going on the fear and greed thing, fear is so much more powerful because nobody wants to be the last one to the exit door. So the fades are much more violent compared to when everyone's comfortable making these slow gains, maybe a percent here, percent there, slowly, until you just get a huge fade. And this was my sell earlier today. I have it on my Instagram because I was kind of doing like a follow along on my Instagram, but I sold that position today on the November 280 strike puts for 300%. And that was about a 2-week hold. So yeah, that's all I have for you guys today. I hope it was somewhat informative. TA is deep, like it's hard. There's no way I could touch TA in even like 2 hours. It's literally impossible. There's so much to talk about. We had one question. Do we have a mic? Hold on. Let me grab her mic. You got it?
Good question.
I do. I'm a little nervous.
Don't be nervous.
Don't worry. We're family here.
Okay, I bought crypto back when it had a lot of lending programs. That's how I found Bitcoin. Then that went away, and then it was ICOs. That's going away. So I never made a lot of money off of it. I've lost money in the lending programs. It worked for a little minute. Now I'm hearing about this thing called a bot. I wondered what you guys thought about the bot.
Bots.
And I have another question on charts, because I wanted to ask the panel about the bot,
Okay.
but you guys ended it. So my question for you on charts, I drive myself crazy at night going on CoinMarketCap.
Yep.
Trying to figure out patterns and stuff, and trying to figure out coins I can make a little money off, daily trading like you guys do, and I'm not very good at it. And there's a coin, I just want to give you one.
Yeah, of course. Take your time.
That it traded, it was up 9,000% for the week last week, and it's
That's scary.
I know. So I worry about.
Get out. If you
I
are-
didn't buy it.
Please log in and sell it right now.
I sit and watch stuff like that for a little while to see if it's going to have a pattern of going up and down. And this is my first time seeing it. So my question is, I don't want to talk a long time, how do you tell when something is a pump and dump, or if it's something that's going to potentially grow to something greater? Maybe people are buying it because it's going to be something great.
That's actually a great question. So I'll answer the bot question really quick, and Randall might actually want to tune in on because That last question is more of a like a long-term investing thing, which again, me personally, I just don't care right now. I know it's probably not what people want to hear. I just don't care about the tech right now. I just use it as a vehicle to trade with. Bots, for example. Oh man. Bots are bad. Like, I have like nothing good to say about bots, honestly, only because there are bots that work, but they're not going to be available to the public. Anything that's available to the public, honestly, is like ready, like you're setting yourself up for potential failure. So like big funds where they build these bots, you know, with their quants and they have a bunch of money to spend on these, that's super customized and it's tailored to what they want. So maybe lower risk, right, lower return, or maybe high risk, high return. Anything available to the public, I would stay clear away from. I know there's a couple bot guys that were here this week that were trying to like pitch me on that stuff, and I hope you're not in the room, and if you are, I'm sorry, but like not sorry. Bots are scary because like so many things can go wrong because you're basically letting a piece of software trade for you, and who knows if that software, even though it's done by permissions and rules that you set, like the thing with crypto, it's very volatile, right? So for example, what if you have a 20% dip today? Is the bot programmed to handle that, to understand if that's happening? No, most likely not, right? Like that takes a human being. So like, even if you do have algorithmic trading, like I still believe in having a human being behind it because bots aren't programmed for the most part that I know of on like human psychology per se, of what's happening right now, that day, at that moment. You know, so if you take like a 15% fade or something, say the algo like skips over it or something, like it's public, right? It's available to everybody. Anything that's available to everybody in the market usually isn't good, besides like obviously a few key indicators like moving averages and stuff, because everybody uses those. Bots I would just stay away from, honestly. Like I know it's probably not the answer you wanted to hear because you sounded really happy about it, but like hate to be the guy. But I'm the guy.
But think about the underlying those three things. I mean, and this is, you're doing everything right. I love that you're researching it, you're looking for patterns. I love patterns. I'm doing the same thing. But from the lending program, which let's be honest, I mean, you're probably talking about Connect, things like that. Total bullshit, total, you know, thank God it's gone. Bad for the industry. But then ICOs to now bots. Each of those, I mean, if we wanted to be real basic about it, I know that's not what you're saying, but it's like, you know, get rich quick. It's like, how do I do as little as possible that something can kind of just get me rich versus just, you know, what Ty has done, a lifetime of learning and studying and really owning the educational and the knowledge base to really excel long term. That's what that's why I would avoid things like bots. And for every bot you understand, there's somebody else with an understanding of bots to beat your bots. And so like literally a lot of people don't realize this, but as you're trying to like buy into something and you're like, okay, I'll set this price and I'll try to buy, and then all of a sudden the price changes, and then you're like, well, wait a minute, now I can't fill my order, so I'll go a little bit more, and then it changes again. You're like, Jesus, what's going on? That's a bot. It's just tricking you into paying a higher price. And so there's a lot of situations like that people get in trouble with because you always have to assume that there's someone smarter and a little bit more devious than you. And so even if you had a bot, there's somebody out there beating your bot. And even without bots, people do that anyways. You know, they'll stop people out of their positions. You know, they'll put up fake, you know, buy or sell walls. There's always somebody trying to game the system. It's not manipulation, but it's just people playing the game. They understand how mass psychology works. They understand, you know, what's that old, you know, the old quote from Warren Buffett, you know, be fearful when others are greedy, greedy when others are fearful. And that kind of goes to your second part of your question. How do you know if it's a pump and dump? When I see percentages, oh, tell me the volume. Like, yeah, there's certain coins in the top, like, you know, they're like the 600 in coin market cap, and they may go up, but really it was like one person buying or selling one thing. And so it really, now when a top, you know, 10 coin goes up 9,000%, okay, something's happening. So you want to see how many people are actually involved in that trade. And then is there a rhyme or reason to it? You know, and so as you study coin market cap, study the news as well. Study where things are emerging, where things are going. You know, why did Ravencoin kind of spike? What's the promise of that thing long term? What's the promise of a Binance coin long term? What are they trying to use it for? What's the promise of Stellar, not only as a currency, but as a platform? What's the promise of Lisk, is actually being able to build additional applications on a blockchain without having to start from scratch? So you realize it's not a pump and dump when there's substance to what's being done, and then some sort of movement in a go-to-market strategy strategy is occurring and people are buying into that. But let's be honest with everything, it's all online poker right now. It's all speculation. There aren't that many real world use cases for crypto today. And so a lot of this is mass psychology. And so a lot of what Ty is teaching and you can learn is just a little window into that psychology and being able to use numbers to back up what's happening in the world.
I also just want to add too on on that last screenshot where Gabe, one of our members, was saying TA actually works really well in crypto because it's not really truly being manipulated yet. And I say that because in the big market, you can have a setup that looks proper. It can be a bullish setup. Everything looks great, but there's like trillions of dollars in the market. So if you're a whale sitting on a bunch of money, tens and hundreds of billions of dollars, whatever it is, and you know that everybody is looking at that setup in a bullish manner, and you know there's so much money behind that to take a bullish move, what are you gonna do? You're gonna take the opposite side of that. So like, I don't wanna say that's manipulation per se, but like TA is pretty solid right now and like in crypto because there's not really that much of shit like that happening yet. So like you almost have to think rationally irrational in the markets, meaning like everything looks right, but what would be the opposite side of this? And do you think somebody is taking potentially that opposite side? Like, I kid you not, once you get TA down and you like understand charting and you can identify, the rest, I swear to God, it's all psychology. That is all it is. It's just how can I take your money or how are you think you're gonna take my money? And like who's gonna win that battle? It's all psychology. You're literally, it's zero-sum game. Somebody loses, somebody wins. You know, am I gonna take your money or are you gonna take my money? You know, and that's really, and the more money you have, obviously the more powerful you can be. So again, like when you see those big moves in like in the big market, you see a setup where everything looks bullish, and it might pop in a bullish manner with a good amount of volume, but then you'll see just a smack down on even more volume to the downside, just wiping everybody else out. So you have to be aware of that too. Again, it's not happening really too much in crypto yet, but it will over time for sure.
Just in the interest of time, I'm sorry to cut you off. Let's grab one more. Kind of, we need to put Dan on. He's going to do. We kind of did this a little bit backwards,
him over there.
But he's going to do a kind of a crypto 101. But Ty will be available after this. Let's do one more question. You know, just to get some kind of. We'll be a little bit democratic. I'm sorry. You had your hand up first, I think.
How do you short cryptos if you don't have a brokerage firm who's loaning you the stock? You
need to have a friend. I don't know if I feel like I need a lawyer for this question. You could hypothetically, right? I can use hypothetical. I know I can use hypothetical. You could hypothetically have a friend that like has maybe a Bitfinex account or like a BitMEX account, and those allow you to short. And that's all I can hypothetically say.
All right, we're going to roll right into Dan without kind of taking a break. So definitely, you know, hopefully he'll do it because he's too humble for his own good. But you know, make sure you give kind of a background on you, Dan. And this is somebody you really want to hear from. And he's going to kind of go through crypto 101, but probably talk on a lot of other topics as well. So let's roll right into that because I know we're a little bit behind. Cool.